Let's get some more thoughts on the commodities space now. We're joined today by Jonathan Barratt from Commodity Broking Services from our Sydney CBD studio. With us here in our Sydney studio, Peter Mcguire from CWA Global Markets and Carsten Scott from the Business Channel. Jonathan, first to you in our Sydney CBD studio. Ben Bernanke's comments overnight did seem to put pressure on the oil price. Just pan out, well, give us the description of how that panned out.
Oh, look, Brooke, what I'm basically seeing from the comments from Bernanke was that a lot of the profits we're seeing at the moment could be just as a result of stimulus packages coming to an end. And I think what Bernanke is saying is that we want to start to see profits as a result of recovery. And I think at the moment that's what's weighing on the markets and also weighing on some of the commodities. Obviously, we saw oil come under quite a bit of pressure last night. And I think that was purely because of the inventories in dollar and also what Bernanke said.
Okay, and to you, Peter Mcguire from CWA Global Markets, you're looking at the Bernanke comments as well. What stood out for you?
Well, Brooke, I think, and good morning, a couple of things you need to consider. He certainly hasn't turned off the tap, and he realises that unemployment numbers are very, very frightening across the US, underemployment as well. And the reality is that the only thing that he's tried to do for the last couple of years is to reinflate asset prices. He's taken the Dow from 6,600 to 10,000, so he needs to probably pat himself on the back. But the Main Street problem is, Brooke, housing prices. And as they continue to go sideways or down, then Bernanke realises that he needs to possibly keep the tap flowing.
It's interesting as well, though, that, you know, in a deflationary environment, you know, with people, the value of someone's home underwater and all of that, that they're still focusing also on conditions to prevent inflation at some point. You know, again, it's kind of the future versus dealing with the present. Do you sense that, you know, he's got the credibility now with markets, that he's onto the case, that he's not just blue sky thinking, that he's planning for today? Pete?
Oh, yeah,
Jonathan.
Yeah, no, I actually feel that he has got the credibility. The market's doing the right thing by him. I mean, if you just look at recent information or inventories on copper, the last 25 days we've seen draws in copper, and that's supporting the price. Now, we did see some negative, I guess, news on housing last night, but overall I think that the market's sort of quite happy with what he's saying, and it's actually a lot of it's coming to fruition in terms of demand for primary imports. So, yeah, I get he's got my vote of confidence.
Pete, what about you?
He followed a guy that only had one mantra, and that was to print money, and that was Al Greenspan. And I think that he's got the same issues there, and he realises that I don't think America has really moved on from 2001, when the Nasdaq crashed from 5,000, hit 2,000 or lower. I think it's trading at around about 2,200 at the moment. They're in all sorts of problems, Brooke, and the only way they're going to get themselves out is to keep on printing money, and I don't see any changes over the next 5 to 10 years. That's the whole reality of it, and I think unemployment numbers will probably stay at this level or increase. If
you think that they're going to be printing money for that long, what are you doing in terms of strategy? And you look at commodities, obviously. Where do you put money, Pete?
I think you've got to look at, that's why the gold price, the smart people have looked at it since 2003, 2002, Brooke. It was trading at the early part of this century under $300 an ounce. It's now trading nearly $1,200. Have a look at oil prices, have a look at all hard commodities, and as Jonathan mentioned, as far as copper prices, we can go back 10 or 15 years and see where copper was trading, and it was under $3,000 a tonne. Now it's nearly $7,000. So hard assets, Brooke, is the only saviour, and that's where the smart money's gone.
Well, I mean, yeah, and yet it's all coming back to China. If you look at the oil demand coming out of the US, the latest print on that, certainly you can't crow about it and say it's pointing to any concerted fundamental demand from that economy.
Well, I even go the other side, the IEA, I don't even trust their numbers, because when you look at the IEA, it doesn't even include Saudi Arabia, who was the world's largest producer, nor China, the world's largest consumer now. Then the reality is that a lot of these bodies that were set up in the 60s and 70s haven't taken on board who the true market participants are now. They're old economies versus the Brazils, Chinas, Indias and Russias that make up the growth engine, and of course Africa, Carson.
Yeah. Were you surprised, you're just back on that gold story as well, perhaps to you, Jonathan, you know, it only really moved about 10 cents. There was a flight back to greenbacks. Yeah. You were surprised at that they went into currencies over commodities?
Well, I think that the US dollar in itself is one that's a little bit better bid at the moment. And I think when you look at gold, I think last time we mentioned this 1180, 1185 is quite crucial from the technical perspective for gold, because if it actually holds above it, then we're still in the old range and the chances are back to 1240, even higher. But if we break through that 1180, 1185 on a daily close, then that does sort of like question the move for some time and perhaps more of a deeper consolidation for gold. I think there are a lot other easier trades out there at the moment rather than gold.
Well, such as?
Well, I think the copper market is something we've been focusing on, and also in some of the softs. We're certainly sort of looking at quite a few of them. You know, obviously the wheat and the corn, but one bit of a curveball here is with rice. Just have a look at the rice. If you can get a look at the rice chart, it's on a 4-year low. And we've got production in China as a result of all the floods coming under pressure by something like 10 to 20%. So when you look at that and you look at the chart, you can see there's a very good story, both fundamental and technical, actually to move into rice.
That applies with, but just back on copper while we get the rice chart, because you've got BHP's production numbers yesterday with copper lower. So if they're producing less, of course, fundamentally, that puts skin in the game for further gains. Surely, Pete?
Yes, I'd say so, and I wouldn't be surprised copper to go back up. I agree with you, Jonathan, probably through 7,500. But speaking of BHP, I don't give a lot of credence to the reports that come out for iron ore prices, because there's really no transparency in that market either.
Right.
And when you look at who has the proprietary knowledge, it's the actual companies themselves, and they use it for their trading advantage.
And let's face it, it was a 12% rise, which a headline looked nice, but it was actually flat on year.
Exactly.
It didn't exactly do much at all.
Yeah, and if you look at iron ore prices, they've collapsed in price over the last 3 months.
And just, Jonathan, I mean, that was one of the more interesting observations maybe from overnight, that you've got people worried and jittery about those Ben Bernanke comments, but copper actually did very well, and it's already had a good run this week.
Yeah, look, it is. Copper in itself, on both fundamental and perspectives, look quite positive. Break of 310 in the futures, I think you'd probably see a move back up to 320, even as high as around that 340, and let's see exactly what happens.
You've got to say that 3% move, Pete, in copper was a short cover play primarily overnight, though, wasn't it? I mean, in fairness.
Probably it was oversold to the downside. It's probably bounced a little bit. You know, it's incredibly volatile when you look at it on a chart.
Yeah. On that one, and Pete, just look at those inventory draws. 25 straight days of inventory draws on copper. It's basically saying that there's physical takeoff at the moment. That is supporting not just a short covering rally. That's real demand, and that's a good thing, and that's a good sign for the overall economies, that people do want the physical stuff.
Is it China?
What?
Just completely China?
No. Well, Jonathan?
Yeah?
Go for it. That was Brooke saying, is that all down to China?
No, it's not. No, it's not all going to China at all. It's just that people are actually feeling that the physical offtake at the moment is just generally across the board, as we've seen with copper, and the chances of expectations of a slowdown in economies. People aren't producing as much, and if they're not producing as much, then when you do see an uptick, all of a sudden you see a squeeze, and I think that's what potentially we could enter into, a bit of a squeeze for physical copper.
Okay, I would put to you, Jonathan, that actually there could be a bit of a mismatch in that view, and Pete, the International Copper Study Group, talking about a deficit between January and April, but when you seasonally adjust, you actually get a surplus. You've got a surplus. You don't have a deficit.
Well, you know, there are so many bodies that have, I suppose they forecast, and if you look, I'll roll that across to, if you look at the crude prices, you've got to go to somewhere like Platts to get a true understanding of what's actually going on with physical markets. And this is a great dilemma where you have the transparency, well, not so much transparency in physical markets versus the futures markets. Who can you really trust?
Well, I mean, if they call themselves the International Copper Study Group, you'd as sure as hell hope that you could trust them.
Well, you'd say the same about the IEA. And they don't even have China or Saudi Arabia involved. So I don't give a lot of respect to any of those agencies, nor OPEC.
Okay,
who do you trust then? Who do you trust? Who do you look at? Jonathan, go to you first.
Look, I think at the end of the day, you've got to look at world-ending stocks for a lot of the commodities, where they're at, where the potential. And one of the things which we haven't focused on is more concentration on weather. You know, we know what's happened with global warming, and this weather is going to be a huge play. In where a lot of these commodities will actually go, and it'll be interesting to see. You know, oil upticks when there's a hurricane. You know, rice might uptick when there's floods. Wheat's certainly upticking with the droughts in Russia and Kyrgyzstan. So weather, in my mind, is a focus that I think we've really got to get our heads around.
Well, yeah, then admittedly, for a lot of what you've just said there, hurricane season by definition is there's a window of time when you know and you plan for the volatility. You've got to look beyond that and understand that it will then go back to fundamentals. Same with geopolitics. There could be a spike in Iran, but one would hope it wouldn't continue beyond a few weeks or months.
Sure.
No, I agree. You've got to have the plans in play. There's no doubt about it.
Yeah.
All right, guys, thank you so much. I think we've got to wrap it up for now in terms of the timing. Jonathan Barratt, appreciate your time there from our Sydney CBD studio, and Peter Mcguire from CWA Global Markets, thank you.
Cheers.
And, of course, Carson Scott in studio with me as well.